So far, the second round of the US-China trade war has been going on for more than 4 months. Now, both countries have released a lot of economic data for the first half of the year. Today, we will take a look at how this trade war is going and how long the CCP can hold on. The bottom line, the return of Donald Trump and the second trade war have disrupted the CCP's original plan to return China into a bigger version of North Korea and to enforce long-term social suppression. This could cause China's economy to break in a way the CCP can't control. It might also give ordinary Chinese people who once had little hope of launching any real resistance some unexpected chances to push for change. According to official CCP data, China's GDP grew 5.3% in the first half of this year, and its total GDP is now about 62% of America's. But I'm sure none of my viewers believe the CCP's GDP numbers. So, what's the real situation? Let's look at another set of numbers also released by the CCP, the percentage of industrial enterprises above designated size that are losing money. In China, industrial enterprises above the designated size means companies with annual main business income of at least 20 billion yuan or about 2.8 billion US dollars. This includes mining, manufacturing, electricity, heating, gas, and water production and supply. The CCP's National Bureau of Statistics publishes the total number of such enterprises each month and the number of those losing money. By dividing one by the other, we get the percentage of enterprises that are operating at a loss. This number is relatively reliable because it is calculated from NBA's data, not directly announced by them. So, from this chart, you can see that until 2017, the ratio of loss-making enterprises stayed at around 11.9%. In 2018, as the first US-China trade war began, the ratio shot up. In other words, the 20% tariffs on Chinese exports to the US during the last trade war already hit Chinese industrial companies hard. By 2022, it had doubled to 22.8%. After the second US-China trade war began this April, by May, the ratio had already jumped to 30.4%. If this trend continues, it could reach 40% by the year's end. Some economists say this kind of level is unbearable for the broader economy. China's cash flow could dry up at any moment, and the normal production and business operations can't continue like this. In short, the crisis of a sudden economic collapse is right around the corner and could explode anytime.